mentioned today, this presentation are wholesale funds which are only applicable to sophisticated investors. These wholesale funds that are mentioned in this presentation are purely for example or illustration purposes. So I believe most of you as an investor, when you invest, you will have a target return. For example, 8% per annum. And most of you, in order to achieve this target return, this is the ideal way of achieving this, a straight line to reach a target return. However, you know that in reality, investing comes with ups and downs. It's volatile, such as in this chart over here, in order to achieve the target return. If you think that this kind of volatility is too much for you, you may want to taper down your volatility of your overall portfolio, and also you need to adjust your target return as well. For example, 6% per annum. If you wanted a higher target return, for example, 12% per annum, definitely you will need to take on higher volatility to reach that target return. But what if I told you we can get similar returns but with lower risk? So using the previous example of 12% per annum target return, this is the typical kind of volatility that you might encounter to reach that target return. But there's a way to achieve this target return with lower risk, lower portfolio volatility. Similarly, if you had a target return of 8% per annum, this will typically look like your portfolio vol, but we can achieve the same or similar return with lower portfolio risk. You must be wondering how, which is why I'm here today, to teach you or to enlighten you on how mathematics can give you ideas or give you portfolio and sort of how to make a better unit trust portfolio for you. It's not as complicated as what you see here, rest assured, but there will be some technical jargons that will be mentioned throughout the session. So some of the technical jargons such as correlation coefficient, correlation matrix, standard deviation, and risk-adjusted returns will be mentioned throughout this session, but I will go through them one by one first to build your foundation before we go on to the examples. So the first key jargon that I'll mention a lot today is correlation. What is correlation? It's a combination of the words co and relation. It is the relationship between two data sets and how they move in tandem with one another. So let's put this into perspective using an example between asset A, B, C, and D. These are fictional assets. Firstly, we have positive correlation. What is positive correlation? That means when asset A moves down, asset B also moves down, and asset A moves up, B also moves up. So you can see they move in the same direction most of the time. Then we have negative correlation. They move in opposite directions. So for example, asset A moves down, asset C moves up. Asset A moves up, asset C moves the other direction. So most of the time they move opposite direction. This is called negative correlation. Then there's also no correlation, the last one over here. Whatever happens in A has not correlated with asset D. Okay, in Chinese or Cantonese terms, it's mo la lang. Okay, for example, asset A moves down, asset D moves up, asset A moves up, and then asset D moves up also. So there's no relation. They just move randomly without any correlation or relation with each other. Okay, so this is correlation. We can measure the magnitude of the correlation using this term called correlation coefficient. This statistical measure is to measure the relationship between two securities, and it usually ranges between +1 to -1, in between +1 and -1. So firstly, we have perfect positive correlation. When you're perfect positive correlation, you have a correlation coefficient of +1, okay, +1. And all the way at the other end, perfect negative correlation, -1. And in between, if there's no correlation, is 0. So perfect positive correlation, you can see they move perfectly together. So when one moves 0.1% up, the other moves exactly the same. Okay, the other one perfectly negative one drops by 0.1%, the other moves up by exactly 0.1%. Okay, high positive, there's also high positive correlation and low positive correlation. So typically when something ranges, the correlation coefficient between two assets range between 0.5 and 1 is high positive. If it ranges between 0 and 0.5, it's low positive correlation. Similarly, for negative correlation, there's also low and high negative correlation, as you can see here. Let's put this into perspective using an example. Example of a positive correlation. So here we have two funds, Afin Huang Select Asia ex-Japan Opportunity Fund and Afin Huang Select Asia Pacific ex-Japan Dividend Fund. So if you notice, they both invest in Asia and both invest in Asian equities managed by Afin Huang, the same fund house. And they have a correlation of 0.99. If you remember from the previous slide, anything close to 1, positive 1 is high positive correlation. And this is almost perfect correlation. And you can see this very clearly through the chart. You see the movement. They move very, very similarly. Okay. And this is because both they invest in Asian equities and they are managed by the same fund house. So when the fund house, the asset manager, before they start investing, they'll typically have a house view, an overall house view. And all the house view, typically the funds would follow the house view. So for example, this year we think that growth stocks will do well. So all the funds under them would most likely follow the similar house view and the sector allocation and the stock selection as well, because they would have a list of stocks, the approved stocks, so to say, that the funds can choose from. And typically they will have the same funds. Therefore, you see when they move quite in tandem with one another. The next one is an example of no correlation. Here we have RSB Global Macro Opportunities Fund, which is using a hedge fund kind of strategy that can do long short kind of investments. Then we have Afin Huang, the same one from before, is a typical vanilla Asia equity fund. They have a correlation of 0.05, which is almost zero. And almost zero means no correlation. And you can see from the chart here is that whatever happens in this line doesn't affect the other line, that there's no correlation. The last one is negative correlation. Here I just use a inverse of one of the funds just to illustrate this. Whenever one moves up, the other one moves at the other direction. Okay, so this is negative correlation. Using this correlation coefficients, we can build a correlation matrix, which is a table to illustrate all this relationship with different assets. How do you read this is, for example, asset A and asset A, their correlation is 1.0. So definitely, because they are both the same assets, they move perfectly to one another. If let's say asset A and asset B, there's a 0.6 over here. That means the correlation coefficient between asset A and B is 0.6, which is positively correlated. Not perfect, but positive correlated. Asset A and C is minus 0.9. So that means they have negative correlation and quite close to perfect correlation, negative correlation over here. And lastly, A and D is 0. So there's no correlation between asset A and D. Okay. Now we explore the correlation between different asset classes. So here I've done some analysis using different asset classes: Malaysia equity, Malaysia bonds, FD, Malaysia property, commodities, hedge fund strategy, venture capital, and private equity, which are all different asset classes. And just look at the average table down here. You can see most of the asset class, they are close to 0. That means there are almost no correlation between asset classes. So the key takeaway from this analysis is there's almost no correlation between different asset classes. So you remember this because we will use this later on in our examples. Between different asset classes, there's no correlation. Example of no correlation between different asset classes, like this one, RSB Gold Fund, which invests in gold, and this Asia Equity Fund, totally different asset class. Their correlation is almost close to 0. Okay, there are almost no correlation between these different asset classes. What about between regions? We have developed markets, Asia, EM, Malaysia, Greater China, and ASEAN. So why we always say diversify across different regions, because they have less than perfect correlation between different regions. And you can see from the statistics here, they are positively correlated, but they are not perfectly positively correlated. And this is useful later on. So the key takeaway from this slide, there's less than perfect correlation between different regions. And some of the regions have lower correlation. You can see here, like ASEAN, Malaysia, compared to like 0.6 for developed markets, or Asia 0.7. Example of less than perfect correlation between regions. Let's use another example here. Principal Global Titans Fund, which is a global equity fund, and Affin Hwang Asia Equity Fund over here, they have a positive correlation of 0.7. So most of the time they do move quite in tandem with one another. It's not perfect, but most of the time they do move close to another, but sometimes they don't. Okay, so that's why it's less than perfect correlation. Next, we deep dive further into individual markets. We split the developed markets into US, Europe, Australia, Japan, domestic Malaysia, and broad market and small cap market, ASEAN, North Asia, and emerging markets. So the key takeaway from this slide would be developed markets are quite correlated with one another. You see, US, Europe 0.8, very close to +1. Okay, US, Australia 0.88. So within developed markets, US, Europe, Australia, they move quite positively correlated. Okay, that means when US move up 1%, Europe or Australia would most likely move around that level most of the time. Whereas Japan, they have a slightly lower correlation with one another. Then another takeaway is Malaysia, ASEAN, and Japan have relatively low correlations with one another and other major markets. And you can have a shortcut here. You just look at this table, the bottom, the average here. And the lower the number, that means the lower the correlation. The higher the number means the higher the correlation with other markets on average. Example, using a fund again. So we have this M China A shares. This one is a wholesale fund investing in China. And we have CAF Tactical Fund, which is our recommended fund from Malaysia equity market. The correlation is 0.48. So it's about, what I say, around 0. It's closer to the 0 mark than the +1 mark. So they are positive correlated, but less than perfectly correlated. Okay, less than perfect is the keyword over here. And the chart also illustrated that they don't move exactly in tandem with one another. Sometimes they move together, sometimes they don't. And this is important to build a portfolio later on. In between sectors as well, because we always say diversify across different sectors. Fund managers, if you look at the portfolios, they typically have a mixture of different sectors in their portfolio. And if you typically follow investments, you know that certain sectors like consumer staples, healthcare, telecoms, and utilities, they are what we call defensive sectors. Okay, non-cyclical sectors, because even markets up and down or economy recession, they're still expected to do okay, because these are sectors that are more defensive. People will continue to consume the consumer staples like your rice and stuff, your food and beverages. Then healthcare, people will still need to see doctor during even economic recessions. Telecoms, people still need their mobile phones, and utilities will be your electricity and water, all this. So these are what we call defensive sectors. And you can see that through their correlation as well. Similarly, look at the table at the bottom of them, the averages. These sectors, the defensive sectors, typically have lower correlation with the more cyclical sectors. The more cyclical sectors are like finance, energy, materials, consumer discretionary. So you see their correlation coefficient numbers are higher than those defensive sectors. So key takeaway here, there's less than perfect correlation between different sectors. Example, an Asia REIT fund compared to a healthcare fund. Correlation between one another 0.56. So it's less than perfect correlation. It's not close to 1. Okay. And you can see through the chart as well, they don't really move in tandem with one another. Next, jargon to dissect would be the volatility. So when we measure volatility, we use annualized standard deviation of returns. Okay, and this is the formula, which is quite complicated, but I'll not go through that. But standard deviation is what we use to measure volatility for investment securities. Okay, if the price of that security moves up and down very very wildly compared to another one, typically their standard deviation will be higher. The higher the number, the more volatile the asset is. We can also calculate portfolio volatility, which is in this formula over here. I'll try to explain this. So we have one part here, which is, in this example, I use just two assets, asset A, asset 1 and asset 2, because the formula is simpler, but this is how it works. The first part is the weight of asset 1 squared times the standard deviation of the asset 1 squared, plus weight of asset 2 squared times the standard deviation of asset 2 squared. And we have this part over here, plus 2 times weight 1, weight 2, times this correlation between asset 1 and 2. This is where the correlation coefficient that we mentioned in the past few slides comes in, and the standard deviation of the individual assets. So we have this part over here. I've got 3 parts in this formula. If you have 3 assets or 4 assets, then this formula will be much longer. But this, to simplify things, I just use 2 and to illustrate this. So if you remember your algebra, you have, if this part, okay, plus 2, weight 1, weight 2, correlation coefficient, standard deviation 1, standard deviation 2, this part, it depends on the number here, because all these, the weight 1, weight 2, and the standard deviation are depending on the asset itself. Okay, you can't change that. But the correlation between the assets, that one, it can help you determine the overall portfolio volatility. So when this number is 1, okay, if you remember, the maximum for correlation coefficient is 1, then this formula, the whole thing, will be the highest. If this number is 0, if this number is -1, then this whole thing will be the lowest volatility. But it doesn't help in terms of your return, because when one moves up, the other moves down, perfectly negatively correlated, they just counter one another in terms of the returns. So what we want is something with correlation close to 0 as possible. So when this is 0, this whole thing disappears, right? Or if it's close to 0, then this whole thing will be minimized. This is what we want to achieve. Okay, example here. Assume that we have asset 1, asset 2, 50% in each. 50% of your money you invest in asset 1 and 50% in asset 2, and both have exactly the same standard deviation of 10%. Then these are all the formulas. So let's say the correlation between these two assets is 1. So they are the same, perfectly correlated. So in the end, the portfolio, when you put them in portfolio, the overall portfolio volatility is 10% also, because they're perfectly correlated and you put 50% in each. If the correlation is 0, this whole thing will disappear. So your portfolio vol is 7.07%, which is lower than the individual assets themselves. If you remember, asset 1 had a volatility of 10%, asset 2 had a volatility of 10% as well. But when you put them together, and if their correlation is 0, you get a lower portfolio vol. This is where the diversification benefit come in. Lastly, if it's -1, yeah, they counter one another, because the portfolio vol is 0 because they counter one another. One goes up, the other goes exactly the same the opposite direction, exactly the same magnitude. They just counter one another. There's no portfolio vol, but you also don't get any returns, so there's no point. So what we want to put in our portfolio are assets that are less than perfectly correlated, as close to 0 as possible. This is based on the modern portfolio theory and capital market theory. So Harry Markowitz, he pioneered this modern portfolio theory. It's a Nobel Prize winning theory, and it states that when investors diversify across different assets that are less than perfectly correlated, the overall portfolio risk is less than the weighted average of the risk of the individual securities, as what I showed just now. And this risk that disappears or eliminated by diversification is called unsystematic risk or diversifiable risk. And capital market theory assumes that diversification is free, and investors, they would not be compensated for bearing risks that can be eliminated at no cost. In other words, investors that do not diversify are taking on unnecessary risk. Let's move on. The next jargon that I'll go through is risk-adjusted return, which is a measure to see how much returns that your investment gets per unit risk. So, for example, Fund A return 12% with a vol of 12%. So risk-adjusted return is 12% divided by 12% equals to 1. If Fund B returns 12% with an annualized vol of 6%, you do the same formula. Okay, annualized return divided by annualized vol equals 2. That means investors are getting double the return per unit risk if they invest in Fund A compared to Fund B. Fund B compared to Fund A, sorry. Because Fund A has a higher risk-adjusted return, so Fund B is better. Okay? You get the same return, but lower risk if you invest in Fund B. Isn't that better? Similarly, we also have Sharpe ratio. The difference is Sharpe ratio, the formula is a bit different. They take the annualized return minus the risk-free rate before they divide by annualized volatility. So this is the excess return that investors get per unit of risk. It serves a similar purpose, which is to compare between different funds. Key takeaways when building your next portfolio: correlation. In terms of correlation, there's almost no correlation between different asset classes. There's less than perfect correlation between different regions, markets, and sectors. And risk-adjusted returns, if you put 2 or more investments that deliver the same return over the same time period, the one that has the lowest risk will have better risk-adjusted return and is better for investors. Okay, so I've talked a lot about theories. Now let's go through the real examples now. Let's assume this investor, he has only one fund in his portfolio, which is 100% in global equity, Principal Global Titans Fund. Okay, this is the statistics for the individual fund itself. It produced 11.6% per annum return in the past 3 years. The annualized volatility, the standard deviation, is 14.1%. And if you remember the formula from before, how to calculate risk-adjusted return, you take the annualized return divided by the standard deviation, you get 0.82. But the problem with this portfolio is it's not diversified enough. It only has global equity. If you invest in global equity, what about other asset classes? What about other regions, other markets? Yep, you're missing out. So let's do some adjustments to the portfolio. Let's add Asia equity to the portfolio. So 50% global equity, 50% Asian equity. You can see here. And the Global Titans Fund has the similar statistics from before, but now we added this Asia equity fund. It produced 12% per annum return in the past 3 years. The standard deviation is 13.8, which are similar statistics compared to this Global Titans Fund, the Global Equity Fund here. And the risk-adjusted return for the individual fund is 0.87. Similar, quite similar. But when you put them in the portfolio together, 50% in each, you get similar returns, the same, okay? But what happens here, the magic happens here is the vol for the portfolio drops. It's even lower than the individual funds themselves. 12.9% vol is lower than the individual funds themselves of 14 and 13.8. Why is that? It's because of the diversification benefits. These two regions, they are less than perfectly correlated, if you remember. So because of that, there's diversification benefit. And if you remember from the formula before, okay, it helps to reduce the third part of that formula. And because of that, when you put them together, the vol of the overall portfolio is lower than the individual assets by themselves. And because of that, you don't sacrifice your returns. Okay, it's still similar returns, but you reduce your risk, which results in better risk-adjusted return, 0.92, which are better than the individual funds themselves. So to illustrate this, we have this chart over here. So the portfolio is the dark blue line. Then we have the funds, individual funds, the red line and the gray line. So you can see the dark blue line is smoother because when, let's say, global equities are down, but Asian equities may not be down, okay, and because of that, your portfolio is more stable, like in this instance over here. Because gray line and Asian equity went down, but global equities went up. So they average each other and you get the middle line. And because of that, you got a smoother line and lower portfolio vol. Here are more charts to illustrate that. So this is the fund, global equity fund. You can see their ups and downs here in the past 36 months. These are the monthly ups and downs of the funds. So it can go down as much as minus 8.7% in 1 month. And it can also spike up by 8.9% in 1 month. Similarly, for the Asian equity fund, maximum, it dropped minus 7.8% in 1 month. It went up by 9.9% in 1 month as well. Okay, but when you put them in a portfolio, because they average down each other, the drawdown is lower. So during this period, when global equity was dropped by minus 8.7%, the overall portfolio only dropped 8.3%. Okay, but you do make the upturn lower as well because it averages as well. But because of this, your overall portfolio is more stable. You have a better portfolio vol and not necessarily sacrificing on your return. Isn't that better? You get similar returns but lower risk, better risk-adjusted return. It's better for investors, right? If you remember from the previous slide, this one, capital market theory, okay, diversification is free. Investors that do not diversify are taking on unnecessary risk. And the broader portfolio theory, investments across different assets, they are less than perfectly correlated. The portfolio risk is lower than the weighted average of the individual assets. So this aptly proves the theory correctly, as I mentioned before. This is what we set out to achieve at the start. If you remember, we try to achieve similar returns with lower volatility. So achievement unlocked. Let's do more. What if we do more examples? In this example, what if we don't diversify across different regions? In this example, we have 2 Asian equity funds. If you remember from the first few slides, these 2 funds, we saw the correlation, right? It was 0.99, which is very, very close to 1, very, very highly correlated. So in this example, we put them in a portfolio, similar 50-50. Both are Asian equities. Their statistics are also similar. You see 3-year annualized return. Okay, and the vol are similar. But when you put them together, there's no diversification benefits. You don't get lower volatility. It's still 13.55, right? Compared to the previous example, when you get lower volatility in your portfolio. Why is this? It's because these 2 funds, they are very, very highly correlated to one another. So there's no diversification benefit. And the correlation is 0.99, right? If you put into the formula before, okay, the third part will be close to the maximum number that you can get. So there's no diversification benefit if you invest in 2 very highly correlated asset classes or assets. In this case, 2 Asian equities, they are managed by the same fund house. So there's no diversification benefit. And if you look at the chart, that is very obvious that there's no diversification benefit. They move very closely to one another. So in short, what's the point of having 2 same thing in your portfolio? So if you look at a portfolio now, if you see 2 very similar assets, actually there's not much point to have both of them in your portfolio. Okay. Now let's use back this 2 Asian equity portfolio. Then we switch to 1 global equity. Switch one of them to global equity. Then you can see the difference already. By diversifying across different regions, you can have some diversification benefit and help to lower your overall portfolio volatility and hopefully boost risk-adjusted return. What happens if we diversify across more regions? So in this example, the portfolio 2 we have here, we add Malaysia. 40% global equity, 40% Asia, and 20% Malaysia. If you remember from the previous tables, Malaysia has a typically lower correlation to other markets. And let's see how it works out here. So we added this half tactical fund. So in the past 3 years, it returned 19.89%. And the vol for this fund is quite high, 20%, which is higher than all the other funds, right? So if you, and the risk adjusted return is 0.97. Okay, so the vol is quite high, but because we added a manageable amount of 20%, okay, it not necessarily increase the portfolio vol by a lot. So by adding this 20% into this fund, you boosted your returns, okay, because the fund did well over the past 3 years, but not necessarily increasing the vol by a lot. Okay, from 12.9 before, now you have 13.6, slightly higher vol, but you boosted your return a lot, and resulting in better risk-adjusted return of 0.99, which is better than the previous portfolio and better than the individual funds themselves. Okay, the higher the number, this risk-adjusted return, the better. So the conclusion here is adding a small percentage of a high volatility fund may not necessarily increase your overall portfolio vol by a lot, while the diversification benefits come in and boosting your risk-adjusted return. Next, how can we make it even better? So previously we only had equities, right? Asia, global, and Malaysia. Let's add some bonds right now. Okay, if you follow our research articles a lot, we always pitch about diversification across different asset classes, and Malaysia bond is one of the core part of every Malaysian investor's portfolio. Because firstly, Malaysia bonds, there's no currency risk. Okay, then there are different asset classes. The way they generate returns is different from the equity funds. And also, Malaysia bonds, they give higher, quite attractive yields compared to a lot of the other markets or bonds outside of Malaysia. So it's a core part of our Malaysian investors' portfolio. So in this example, let's put 20% in global equities, 20% in Asian equities, 10% in Malaysia equity, and 50% in Malaysia bonds. So effectively, it becomes a balanced portfolio, right? Because 50% bonds, 50% equities. So if you look at the individual statistics as such, but when you put them all together, okay, the return about 10.8% in past 3 years, the vol almost halved from 13.66 before becomes 7.2, almost half, right? And because the volatility has dropped so much, reduced so much, it boosted the risk-adjusted return by a lot. Now you have a risk-adjusted return of 1.5. That means every percent of risk that you're taking, okay, you're generating 1.5% of return. So previously, the previous portfolio, every percent of risk that you take, you're generating 0.99% of return. So of course, the 1.51 is better, right? And you can see why the portfolio vol has dropped so much, because you can see from the chart here, it's much smoother compared to the previously 100% equity fund. Sometimes equity do well, sometimes bond will do well. So that's where the diversification benefits come in. And in terms of the drawdowns and the upturns, the movements, monthly movements, is also much lower. So if you remember from the previous slides, the full equity fund portfolio, it dropped as much as 8.9% in 1 month. But if you add in like 50% bonds, it can help to weather your portfolio better during all this market downturn. It only dropped by 5.2%. Okay, so this explains why the vol of the portfolio dropped or reduced by so much. And you can actually achieve better win rate. So what is win rate over here? In the past 36 months, we take how many times the portfolio has returned positively compared to the number of times. So in this portfolio too, which had 100% equities, the win rate was 72%. And if you put like 50% bonds, okay, a balanced portfolio, you can achieve better win rates. That means on a monthly basis, 78% of the time you produce positive returns, which is a good number, right? I think most, if you go to casino, if you can play a game that can have 80% win rate, yeah, that the casino games, the casino would probably bankrupt already. So I think for this example, this tries to illustrate why we always advocate investing in a diversified portfolio across different asset classes. Next, how does this compare against other balanced funds? So we just created one portfolio just now with 20% equity, 20% Asia equity, 10% Malaysia equity, and 50% Malaysia bond. And how does this compare to other balanced funds that we have? So you can see in terms of the return, 10.8%, not bad, okay, compared to other balanced fund. And the vol is much lower compared to the other balanced funds over here. And because of that, the risk-adjusted return is much better. Okay, because we get to pick and choose the best among the different asset classes and regions, so we can achieve a good return. Then we also can achieve better volatility and better risk-adjusted return. So this is what we set out to achieve at the start, right? If you remember, this moderate risk investor had a target return of 8% per annum. Okay, we can achieve that with a diversified portfolio. We can achieve that return, not necessarily sacrificing the return, but with lower risk, lower portfolio vol, and resulting in better risk-adjusted return. So achievement unlocked as well. Let's say you want more. Now we have the core portfolio already. Okay, global, Asia, Malaysia, and Malaysia bond. So let's add some supplementary positions, which we also have on offer in our platform. Investors can gain access to different asset classes like hedge fund strategy, commodities, and gold, for example. So in this example, I just added a small amount into Global Macro Opportunities Fund, which is the hedge fund strategy fund, and a small amount into gold fund, which invests in gold. So what happens to the overall portfolio? Well, from 7.2%, we managed to push it down to 6.7%, lower vol, but not necessarily sacrificing the returns a lot. You still get quite similar returns. And because of that, your risk-adjusted return is better, right? Let's add sectors and single countries right now. So these are three funds that we added. M China A, which we like. These three funds are the markets or sectors that we like. So in this example, I try to illustrate it right here. So China A fund, Global Technology Fund, and a Global Healthcare Fund over here. We added small amounts in it. Not like big amounts, not like 10, 20%, but like, let's say 4% in this example. So what does it do to the overall portfolio vol? It slightly increased it, but it boosted the return. Okay, by adding this, if you notice, the individual funds themselves, okay, like China A, the vol is quite high, 19%. The technology fund also quite high, 16%. Then the global healthcare also 15% vol. So these are quite high vol funds. But if you add small amounts of them, it does help, not necessarily increase your portfolio vol by a lot. Okay, from 6.7, the vol increased a bit to 7.5%, but your returns, the potential returns is increased. So resulting a better risk-adjusted return, 1.63. So this is improved as well. So from the initial portfolio that we had, which only had global equity, with these statistics, 11.6% per annum return, 14% vol, and 0.82 risk-adjusted return, we managed to improve this by this much. The risk-adjusted return doubled just by diversifying across different asset classes, different regions, and not necessarily sacrificing your return, your portfolio returns as well. So this is what we strive to achieve at the start, right? Very similar to what I illustrated at the start. We try to achieve the target return for aggressive investor with lower portfolio vol. Achievement unlocked. So we have proven the modern portfolio theory and capital market theory as pioneered by this Harry Markowitz. And some key takeaways, okay, for the mathematics of diversification. Diversification is a risk management technique that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose lower risk than any individual investment, right? If you remember from my examples, by diversifying, you not necessarily sacrifice the return, you get similar returns, but lower risk. So it's better for the investor, right? And this diversification, it strives to smooth out these unsystematic risk events in a portfolio so that the positive performance of some of the investments will neutralize the negative performance of others. Smooth out unsystematic risk. And therefore, the benefits of diversification will only hold in if the securities in the portfolio are not perfectly correlated. If you have a few funds that are very similar to one another, you don't necessarily benefit from this diversification benefit. Diversification. Most non-institutional investors, because they have limited investment budget, you might find it difficult to create an adequately diversified portfolio, right? Because let's say your funds are limited, you can't buy a lot of stocks, you can't buy a lot of bonds, but that's why we have this thing called unit trust. Through unit trust, it's an inexpensive source of diversification. You buy one fund, you're already holding a portfolio of different stocks inside, and these stocks are already handpicked by all the fund managers. So these are some key takeaways. And when you're building the next portfolio, try to remember these few points. Between asset classes like bonds, equities, private equity, hedge fund strategy, all these asset classes have have no correlation with one another. And between regions like developed market, Asia, Malaysia, there's less than perfect correlation between one another. And different markets like Japan or China or India, they have also less than perfect correlation with one another, and between different sectors as well, which is why when we invest in a portfolio, we typically have different regions, different markets, and different sectors. And we have proven that it works using the examples before. Risk-adjusted return, if two or more investments, they give the same return, the one that has the lower risk will be better risk-adjusted return. And by adding limited percentage of a high vol supplementary position, you may not necessarily increase the overall portfolio vol. But if you add a big amount, okay, then your portfolio vol will increase. So that's all from my session today. I'll move on to the Q&A. I think let's go through the questions. I read that correlations between asset classes changes with time, and thus would seeing current/past 10 years correlation and planning asset allocation helps. So correlation between asset classes change in time, but it may change a bit. But what I've seen is, if you look at the longer term, it's still there's still the less than perfect correlation between the different asset classes. So across time, they may change a bit, but in the longer term, it's still that they still have close to no correlation with one another. Where and how can I mine to calculate correlation between two asset classes? Okay, I think I have examples here. Okay, so these are the how you can do it yourself. How do you calculate correlation between two asset classes? So you take them. Let's say in this example, Afin Huang, this fund and this fund. Okay, you have the daily, the movement, okay, the monthly NAV of these funds, and then you can calculate the monthly change. So for example, this fund, okay, in the first month it dropped 1.1%, the other one dropped 1.4%. Then in the second month, this one dropped 6.3%, and the other fund dropped 7.1%. So you do this calculation in Excel. Okay, you have this complicated formula, but fortunately Excel, they have this function called equals correl, and then you bracket, and then you put in all the monthly changes of asset 1 and the monthly changes of asset B. Then you'll get your correlation number. You can do it yourself. So in this example, I just used 12 months, but in the previous, this to show how you calculate it easier. But in my previous examples, I've used 3 years. Okay, so the 3 years one, you just do like 3 years every month, the monthly change of the fund. Then you can calculate the correlation between different asset classes yourself. Okay, next one. Why China equity is missing in chart? Oh, okay. So in the end, I did mention China equity like as a supplementary position, because in your Asia equity you would already have some China equity. So these are supplementary positions that into sectors or markets that we like. So yeah, I think this one I answered already. Gold is considered materials. I would say gold is considered commodity. Yeah, gold related commodity, and because I think the way they move is quite different from other commodities as well, because a lot of investors or the markets tend to see gold like a safe haven asset to go in when markets start to get volatile or uncertain. So the way they move is quite different from other or the other commodities, and therefore you can also see it as asset class by itself, because of the safe haven safe haven kind of characteristics that it has. So where can we find correlation between funds in FSM website? Okay, currently we don't have this number, so I did all this myself using Excel. You can do it yourself lah. If you have the data of the NAV of the individual funds, then you can do it yourself. Hope you can share the slides to us to have better understanding. Okay, this video is recorded and will be posted on our YouTube and our website, so that you can refer to this again in the future should you need any advice lah. So or if you can't remember some of the formula you want to revise, then you can also go through the video again. I try to make it as layman as possible lah. So a lot of the technical ones I didn't really mention, but the key ideas, the key takeaways are based on all these statistics. How to get all the readings, standard deviation for fund. Okay, this one, we do have the standard deviation for the fund in the fund selector. If you use, we have if you go to our website FSMOne.com, under the tools part, that you can search the funds, and then if you go to one of the tabs, I can't remember, I think fund performance or something, there's you can see the standard deviation of the individual funds over there in the past 3 years. How to get correlation value? Okay, this one I calculated myself, but if you want to get it from website, currently there's no such function. But the idea today's session is to illustrate to you and prove to you that by diversifying across different asset classes, regions, and markets, you do get diversification benefit, and this is where the correlation between different asset classes come in. So I think the main point of today's is to instill this key takeaways into you when you build your next portfolio. How do we calculate correlation? Okay, this one I talked already. This information is not available in the website. I did this all myself using Excel. Yeah. As I explained in the example just now, would picking up funds with the highest RAR make a sensible portfolio? Yeah, you can do that. So RAR, the risk-adjusted return or Sharpe ratio, is best used to compare between different funds in the same category. So like, for example, in Malaysia fund category, if one fund is giving better risk-adjusted return compared to another fund, that means the fund manager is doing a better job. They both invest in same Malaysia equity, but one is outperforming in terms of risk-adjusted return. Yeah, so it's a good way to filter funds as well. What's the correlation between growth and value fund? Okay, this one I don't have the number right now. How do we allocate the money in 3 sectors? For example, you allocate 40, 40, 20. Okay, I think this one, there's a few ways to allocate. Again, you can go by the size of the economy, okay, by GDP, or you can go by, actually this one is quite, I would say, flexible, but typically FSMOne, we will have core portfolio, and our core portfolio would typically include global equity, Asian equity, and Malaysia equity for equity part. Then you have the core bond part. Then after that, you add on the supplementary positions into sectors that you like, but you don't add too much lah. You add like few percent into like technology, few percent into China A, and so on. So the core portfolio typically would have the global equity, Asian equity, and Malaysia equity, and Malaysia bond. So in terms of the allocation, I think I would say this 40-40-20 was based on the GDP of the individual country, the GDP size of the individual regions. So the bigger regions like global and Asia will get 40% each, and then Malaysia, because it's slightly smaller, so we put 20% allocation into Malaysia. On your table, you shared on correlation amongst all the markets. China is not on your table. Okay. This one, I think in my example, I used the Hong Kong Hang Seng. This one would include the Chinese stocks in here, but there's no additional for China A, which probably I'll add in the future. Yeah, that's a good one. So 50-50 better to lower risk, but return is lower than 100% equity. Yes, so definitely you can't really expect a 50-50 balanced portfolio to outperform the equity portfolio, 100% equity portfolio. But what we try to achieve here is better risk-adjusted return for the investor, so that in situations like market downturns, your portfolio is less volatile compared to the 100% equity one. And for investors who want to have a good, good sleep at night without much worry, a 50-50 portfolio in terms of equity and bonds would be a good choice, right? So let's see the example here. Yeah, so depends what you want to achieve. If you have the risk appetite to take on all this market volatility, for example, like drop 8.9% in 1 month, if you're okay with that kind of risk, yeah, then it could be good for you in terms of 100% equity. But for maybe a lot of investors, they just want try to sleep well, sleep better at night, less worry, then a 50-50 portfolio will work well for them, because in times of downturn like this, minus 8.9%, your bonds would help to cushion this kind of drawdown. So for example, portfolio 3, minus 5.2%. And yeah, it's only 5% drop. You recover faster also. And therefore the win rate also higher. So depends on ultimately it depends on what you're trying to achieve. If you want like maximum return, of course 100% equity will do that. But if you want a smoother journey to achieve your target return, maybe slightly lower, but achieve through a smoother portfolio, smoother volatility, yeah, definitely some diversification across different asset classes will help. If the intention is to maximize return over 5 years, it's still advisable to add bond. If yes, what could be the strategic asset allocation? Okay, this question is quite similar to the previous one. If you want to maximize return, of course, definitely 100% equity, but you must be also wary that in market downturns like that, your portfolio is more volatile. So by adding a bond, even like 20% of your portfolio in bonds, it does help. Ultimately, I still believe that diversification is the best way, because different asset classes, they produce returns differently. There are times that equities would underperform, but bonds will still continue to help you generate that kind of interest or income throughout the year, right? So when equities are down, you still get the bonds to kind of cushion your portfolio returns. So which is why we always advocate investing in diversified portfolio. Okay, no matter how good fund portfolio adjusted return or any statistical, it still does not indicate future would not do self-reflection, self-correction. Yeah, I think in these examples, we use historical statistics, okay, to illustrate why we diversify across different asset classes. It's not a promise that they will return like 10%, 20% return like that, but it's more to illustrate why we invest in a diversified portfolio of different asset classes, how it can help you reduce portfolio vol, but not necessarily increase, not necessarily sacrificing your returns. Okay, so it does not guarantee the future return, but it's used to really prove that if you invested in diversified portfolio, your drawdowns will be lower during market correction, for example, then your overall portfolio vol is lower. For some investors, yeah, that's what I want to achieve. I want to invest in a smooth kind of way, less volatile one, and achieve similar kind of returns, better risk-adjusted returns. So, yeah. Next one, how FSMOne managed portfolio and iFast managed portfolio design, are those funds in the managed portfolio will be revised or changed? Yeah, so the fund manager, the portfolio manager does actively manage the funds. So they'll do the allocation and they'll make decisions whether to overweight or underweight or neutral certain sectors or markets based on the outlook of the market. So they do it actively, and they do change other unit trusts. They do switch the funds if, let's say, they find that the fund is underperforming or the fund does not meet their, if they look at the fund's portfolio, it's not the strategy that they want to take. They want to go for more growth, then they can change from the more income focused one to growth focused one, for example. So the manager does actively manage the fund. How much diversification is bad? Over diversification. Good question. I think there's no, if you diversify across different things that are less than perfectly correlated or no correlation, then the benefits will still continue. So if you notice, I keep adding new asset classes, right? Then it does help in terms of the portfolio vol, the portfolio statistics. So I would say if you diversify across things or asset classes that are less than perfect correlation or no correlation, it continues to help. But if you diversify across very correlated things, like let's say just now the two Asian equity funds, it doesn't help. So it depends on how you diversify. Bonds offer ROI like FD rate, and if the market is bullish, we should buy 90, 100% equity funds to optimize ROI. What does iFast or FSM portfolio managers evaluate in changing stock market conditions? Okay, so correct. So for bonds, they are like a, you can say like a, you can say FD alternative. If for investing in bonds, they give similar like income, regular coupons, income, accrued interest. They give slightly higher returns compared to FD, but of course you're taking on higher credit risk. So there's a credit risk over here. And if the market is bullish, we should buy 90 to 100% equity funds to optimize. So if, I think it depends on your risk appetite, whether an investor should go 90 to 100% equity. Okay, if you're aggressive one, only go 90 to 100% equity typically. So if market is bullish, I would say you can take, it depends also. I think if the market is bullish and there's still upside, then you can take a bit more aggressive position. Like for example, let's say you're a balanced portfolio investor, 50-50, 50 equity, 50 bonds. You can go maybe 55% into equities, reduce the bond part if markets start to turn for the better, for example. So this is what iFast or FSMOne portfolio managers do as well. They look at the market outlook, okay, for the market. If there's upside or the market is cheap and it's undervalued right now, they can increase their overweight position into that asset class or the region. So some funds seek long-term investors, but volatility statistic use 3 years number. Yeah, there's 5 years number. You use the same formula, you can calculate. Just calculate based on the 5-year numbers. Yeah, it's doable. When should sell if profit above 15% and above? Okay, so I think it's nothing wrong to take profit. Okay, take profit is a natural thing. I think it's okay to take profit. When to take profit, I would say when the market becomes overheated or too expensive, then there's little upside. Okay, there's little upside or the risk that it may come down if it's overvalued. So one example I can think of is glove stock. If you remember, glove stock flew through the roof, skyrocket, then it becomes super overvalued. Yeah, then if you know that, if you think that, okay, after the pandemic, glove will probably, the prices won't maintain at this kind of absurd levels or not, and all these super profits for this glove company will come down. So yeah, then you should take profit lah, because it's already overvalued at the time. So it depends on the outlook and the valuations, I would say. The FSMOne website has portfolio calculator? Oh, okay, we do. We have the portfolio simulator in our tool. If you go to the website, then under portfolio simulator, you can play around with it. You add a few funds, then you add the allocation, let's say 50% in each, then they'll calculate the statistics for you. Yeah, there is. So does you have a portfolio for us to follow? We do have, basically the ideas that I shared here today, okay, are the ideas that our portfolio managers use as well. So that will be, if you want a portfolio to follow, you can follow that lah. Yeah. So they have different portfolios for different investors with different risk appetite. So you have conservative, moderately conservative, moderately aggressive, and also aggressive portfolios, which you can follow. Is the MAPS bundle with equity and bond like discussed here? Yes, correct. They're built using the same principles. Is RAR same like Sharpe ratio? Okay, this one I think I explained before, but I'll just go through again. So RAR, risk adjusted return, the formula is an annualized return divided by the annualized volatility. Okay. Sharpe ratio, okay, this is typo here. Sharpe ratio is annualized return minus the risk-free rate divided by annualized volatility. So the difference is this minus part, but they both serve the same purpose, which is used to compare funds within the same category. Okay, so the fund, if you look at the same category, like for example, Asia equity, so the fund manager that can produce the best risk-adjusted return, or it should be better, right? Because they are producing more returns per unit risk for investors. How to decide on percentage of diversification across different sectors, fund type, and geographic regions for optimal risk-adjusted return. Okay. Yeah, so in today's example, I just use like ballpark number, very like 40%, 40%, 20%, so easier to talk. But you can actually play around with all these numbers, okay, to achieve this maximum diversification, maximum optimal risk-adjusted return. There's a thing, it's called okay, I can't recall, but yes, you can do that. You just play around with the percentages and the different funds, then you can achieve this maximum risk-adjusted return. How to include timing into mathematically to invest? Okay, this one, how to include timing? I would say you other than knowing how to allocate your portfolio, you also need to monitor the markets. So if you monitor markets, you look at the upside, the outlook, then you can also make adjustments to your portfolio based on that. So for example, like recently the drawdown in Chinese tech companies, right? So if you think that the upside, okay, of course we think that the upside for Chinese tech company is still there. Okay, it's very cheap right now. So what we do is we just allocate a bit more of our portfolio into Chinese technology or Chinese equities. Yeah, so we add supplementary positions into our core portfolio to take advantage of this tactically. What's the significance and impact of, okay, this one I explained already. What is the max percentage we allocate for sector or healthcare or China, can you put 10%? Yeah, we okay, typically, I think I would say 10% max lah. These are, if you follow our website, we do have this thing called risk rating. Okay, each fund will have a risk rating from 0 to 10. So those single sector ones are like technology or global healthcare, because they only invest in one sector. Okay, so their risk rating is the highest, 10. So this risk rating high 10 ones, typically we don't try to over concentrate ourselves into these. And typically these are what we call supplementary positions to add to your core portfolio. So yeah, you can put 10 as long as 10% in your portfolio into this single sector or single country, as long as it's within your risk appetite. But it's not recommended to go like too much, like 20-30%. That one is over concentration already. Is this model applied to dollar cost average? Yeah, you can use this to do the dollar cost averaging. So basically, the idea of this is just to show you why we diversify across different asset classes. Then the dollar cost averaging, you can do it yourself. It is applicable as well. I think what you shown here is exactly same method, FSMOne. Yeah, this is what they are built based on the same principles. The managed portfolios, they are built on the same principles. That's why you see we have different asset classes. Okay, you have equity, bonds, then you have different regions and different markets, and the sectors that we like, then we add a bit more in supplementary positions. And if you notice, the percentages also are quite manageable in terms of they don't over concentrate into one sector, because if you over concentrate in one sector, you may cause the portfolio vol to spike up a lot. So if you add just a small amount, it does help in terms of diversification. But if you add too much, then it will over concentrate your portfolio. There are many newer funds below 3 years. There's no vol Sharpe ratio. Yeah, because there's no track record, correct? For in this case, I think just remember the asset class that you invest in. Is it because there's no track record, right? Let's say it's a new fund, invest in China, there's a new fund, then there's no track record. But if you think that if you look at the outlook and the upside of that region, the market, then it's still worth to put in your portfolio, then yeah, why not? It's still the main idea is still that if you diversify across different asset classes or regions, all this, you still achieve your diversification benefits and lower your overall portfolio vol. Because FSM has past daily monthly price for the past 3 years so that we can work. We only have, I think, daily NAV, but up to a certain date only. So we don't have the full one. But you can use our portfolio simulator tool to do your simulation and count the statistics. It'll auto calculate for you. If I were to just build a portfolio based on 60% global equity and 40% precious metal, okay, I would expect a very volatile portfolio. Precious metal is quite a volatile asset class. Okay, I think their vols is like 30% or something. So if you remember just now, I was showing you a few examples. The vol were like 10-20%. So precious metal, their vol are like 30%. So if you add them in portfolio and such a big amount like 40%, definitely your portfolio will be quite volatile. So yeah, that's what you would be expecting. Does this model applicable? Is the same question. Do you think the investor's age and indirectly investment horizon should play a part in the allocation between equity and interest bearing? I was told many years ago that if you are 20 years, do you think this rule of thumb still makes sense in today's market? Yeah, definitely, because you also need to consider the investor's risk appetite. Not everyone young means that they can take on a lot of risk. So, and not everyone that are old are very conservative. Yeah, there are also elderly people who likes equities and they know what they're investing in. So most importantly, they know the risk, they are okay with the risk, then yeah, I think this age one is just a rule of thumb, but it depends on ultimately your risk appetite and investment experience as well. Will FSM managed portfolio use? It's built on the similar principles. Does this model apply? It's the same question. What? Why not long term? Okay, why is the data using 3 years? Why not long term like 5 years? Okay, we can use 5 years also, but I think 3 years is I would say the more recent data, because some funds may not have 5 years history as well. So I just use 3 years then, and it's more recent lah. So what is the optimum asset class in a portfolio for higher return with lower vol? Okay, good question. I think if you look at maximizing risk-adjusted return, definitely cash management fund or money market fund, the risk-adjusted return is the highest, but you may not necessarily achieve the return that you want. So ultimately, it depends on what is your target return, then how you can achieve it. Then you play around with the asset classes to see. But yeah, if you just use risk-adjusted return, of course, all those cash management fund, all those will have the highest risk-adjusted return, but because their vol is like close to zero, that's why the number looks very high. So what is the optimal asset class? Depends on, I guess, your risk appetite, and then what's your target return. If you want like highest return, 100% equity, then maybe you try to diversify between different equity markets. Okay, different equity markets, different asset classes, then you can still help in terms of diversification. As what I showed just now, just like Malaysia. Let's see. Okay, so yeah, this one is like full equity. No, this one is full 100% equity, but different regions, different markets. So you still can actually achieve some diversification benefit just by diversifying across different markets and not necessarily sacrificing on the returns. How can we know our correlation when we also invest under EPF funds for more than 20 years? Okay, this one I don't quite understand the question. As long as 3-year vol number is lower than 3-year annualized, that means diversification is good. I would say as long as 3-year vol number is, I think as long as the 3-year vol number is lower than the individual funds themselves, then you can see it's definitely diversified. The benefits are there. So for example, like this one, there are 3 equity funds, right? Global, Asia, and Malaysia. There are individual vols of the individual fund, 14, 13.8, and 20. So if you think naturally, you invest 40, 40, 20, it's like the weighted average, right? The portfolio vol. But in fact, it is not. Okay? It's even lower than the individual funds themselves. And because of that, you don't sacrifice your return. You get better risk-adjusted return. So I would say to determine your overall portfolio vol is lower than the individual funds themselves, then it's already a success. What is that 3-year number? Yes, it's 3 years. Yes, it's 3 years annualized return. Sorry. So that means in the past 3 years, it produced a 11.6% per annum return in past 3 years. This one similarly 12% per annum in past 3 years. How to design a fund that will give 8% with the lowest vol? Annualized return is same as compounded annual growth rate. It's the same. So how do I design a fund that will give 8% return with lowest vol? So I think if you want, you can follow this example that I put out here. 8% return. So okay, I think the 50-51 looks good if you're like yeah, this one. So this one, it returned about 10% per annum in the past 3 years with a vol of 7%. So risk-adjusted return 1.5. So this portfolio gives you global equity, Asian equity, Malaysia equity, and also Malaysia bonds. Yeah, the vol is quite low, 7%, which is actually, in fact, lower than a lot of the other actual balance funds. Why don't you use Sortino ratio? Is there not a better method of measurement? Sortino ratio, okay, so Sortino ratio is another sort of Sharpe ratio, but the difference is instead of dividing by annualized vol, they divide by the annualized downside volatility. I think personally, I think it's not a true reflection of the vol of the fund. Okay, if you look at how they calculate, it might skew lower if it could be skewed lower. Yeah, basically the Sortino ratio, because of the annualized downside volatility, the difference is if you calculate the downside vol, they only take the downside, the drops in the portfolio. It doesn't take the ups in the portfolio. Okay, so for example, like this example, they will only take the negative ones. They'll ignore the positive ones, and because of that, right, the average of, if statistics are, the average of these negatives one could be skewed lower, because when you calculate this standard deviation, you see this, they'll minus off the average, the mean, okay, to calculate this standard deviation. And because if let's say the fund is it could be skewed lower, which doesn't fully reflect the true volatility of the fund, if you know what I mean. So I typically don't really use Sortino ratio that much. How accurate is your portfolio? Yeah, it's accurate. The difference is they use daily NAV. Here in my example, to make it simpler, I use monthly. Would it make sense to calculate 1 year horizon RAR for new funds? I think, of course, the longer investment horizon, the better. But if let's say, like you said, the fund is new, they only have 1 year track record, then yeah, you got no choice. But in the past 1 year, we also had quite some number of events. If so, that could be a good gauge of the fund, how the fund managed to weather all these kind of market corrections as well. So the longer the better, but if you only have 1 year 1 year track record data, then yeah, just use it. For conservative portfolio and managed fund, what is the reason to have so many bond fund instead of 1 or 2 bonds? Okay. So bond funds, so when you invest in bond fund, it's already investing in a portfolio of different bonds, right? You invest in one bond fund, you invest 1,000 ringgit, but you gain access to a lot of different bonds. But let's say this 1,000 ringgit, you invest in 2 bond funds, for example, then you're further diversified in terms of the credit risk, the credit risk of the individual bonds there. Okay, so there's still diversification benefit in terms of the credit risk. So 1,000 ringgit, initially you buy maybe 10, just pure illustration, 1,000 ringgit, you buy 1 bond fund. Inside that bond fund got maybe 10 companies. Okay, but let's say you take the 1,000 ringgit, you split 500, you buy this one, got 10 companies, and then 500 you buy another bond fund with another 10 companies. So your 1,000 ringgit diversified into 20 companies already. So there's the what's the benefit from that is don't put all the eggs in the one basket theory. If one company goes down, your risk will be the hit to your portfolio will be lower. Now there are many foreign funds with option or hedge and non-hedge. Based on risk versus return, how do we do our selection? Okay, there are many foreign funds with, okay, that's true. We have now investors, they have even more options compared to before. Their hedge classes, non-hedge classes. So ultimately it depends on you, what you want to achieve. If you don't want the volatility in the currency, then you invest in a non-hedge class. So you can see your overall portfolio vol will be lower. Okay, but if you want to bet on the currency appreciation of the foreign currency, then you can go for the hedge one. But if you just want like smooth journey, I just want the return of that market, I don't want the currency volatility in between, then you go for the non-hedge one, and you see your portfolio wall will be lower. Should we include ETF investment into our funds portfolio when we construct the correlation table? ETF already invested high percentage in local market and equity market bond. I think in my personal opinion, I don't add the ETF one because I treat it as an asset class by itself, because the way they generate returns is also quite different from your bond and all those. And yeah, it's a good question, but for me, I think it's personal. I think it's personal. If you want to consider ETF as part of your overall portfolio, that means they already cover the local equity or bond and so on. But if I think of ETF itself as an asset class, right, they're generating quite stable returns for me separately, then it's a different story already. So I think personal opinion. What is the risk-free rate used for Sharpe ratio? Okay, this is good question. Why I don't use Sharpe ratio here? So if you notice throughout my session, I use risk-adjusted return more, right? Because Sharpe ratio, you need to take off this risk-free rate. So the question is, what risk-free rate to use? Because different market, the risk-free rate is different. Malaysia risk rate, let's say Malaysia risk-free rate is FD rate 2%. But if you go to Singapore, the risk-free rate is different. You go to US, the risk-free rate is different. So it's hard to put a number to this. That's why I use the pure risk-adjusted return over here. Then another thing about this risk-free rate, right, is because it also changes over time. So this return 3 years, right? Let's say Malaysia market. In the past 3 years, we already seen the OPR go up, OPR go down, and then now we are record low. So over the past 3 years, different risk-free rate. So what risk-free rate are we going to put to make it fair for this fund manager? So therefore, I just use risk-adjusted return, because the main purpose for me is really just to compare within funds and then see how it improves the risk-adjusted return. Return of different asset classes vary with different time period. This calculation is a good indication basis, but don't expect the same performance to repeat. Okay, so yeah, the past performance is not an indication of future performance, but in this example, we use it to prove to you that by diversifying, okay, you not necessarily sacrifice the return, but you can reduce the overall portfolio risk. So when you invest, you need to know whether this market cheap or not, whether got upside or not, what are the risks to the market, and whether can make money or not to further adjust your portfolio. So this one, to know this better, probably you go and read some of our, we do have articles like how do you position yourself for this year, 2021 at the start of the year, and then second half, we also how do you position your portfolio in the second half of the year, and then most likely towards the end of the year, how do you position your portfolio for the next 2022. So those kind of article will have recommendation like, do we overweight equity or not? Do we overweight Asia or not? Or within bonds, do we go long duration or short duration, and so on? So we do have those articles for you, and also we do have webinars to convey those information as well. So the past performance is used to here is just to prove to you that it works then also another thing about using past performance, that's the best gauge that we have to differentiate between different fund managers. Similarly, all the funds invest in the same asset class. Of course, we want to invest in the better fund manager, right? If you invest in multiple bond fund exposure, would not be doubling out our exposure given our limited onshore ringgit issuer and issuances, as most bond funds would have the typical bond issuer in their holdings. I would say not necessarily lah. All the bond funds, they'll have, I think they'll do their own credit analysis and pick the companies that they think will do okay. And there's also another thing is not every bond fund will have the same access on, because when bonds are being issued, okay, you need to so-called bid for it, like IPO like that. That not necessarily you'll get the allocation. So some bond funds may have different issuers compared to other bond funds because of that, because of selection, the way they select, and also because of whether or not they can get the allocation in the end. Why FSM uses Sharpe ratio instead of risk-adjusted return? Okay, I think the Sharpe ratio, I would say, is a more famous one, therefore they use it until now. This has been there since the start until now. So, but it serves the same purpose. You just want, if you want to just compare between different funds in the same category, they serve the same purpose. The number in the end will be the same one. The outcome, the outcome, if you look at RAR of fund A, fund B, or the Sharpe ratio of fund A, fund B, the outcome is the same. Are you implying that non-hedge foreign fund has less risk than hedge? I think the hedge one will be, maybe I talked too fast just now. I said mentioned the wrong thing, but the hedge one would have lower risk because of the currency is already hedged. So you don't get the currency movement, you only get the market or the asset class movement. Do you think tech healthcare ETF are overvalued right now? Okay, so we recently, so for tech overall, I think the market, overall it doesn't seem, overall we're neutral, but in between different asset classes, I think different sectors within the tech, there's still opportunities. It depends on the security itself and what they're priced in. So for now, we recently just downgraded semiconductors from attractive to neutral, okay, because the valuation have gone up quite a bit. But other than semiconductors, if you look at the overall tech, there are other sectors that also got upside. So within the tech sector, I think right now we like the bigger tech companies. Okay, they are less expensive, and they are also fundamentally much stronger than some of the smaller tech companies which don't have profits, don't generate positive cash flow, these kind of companies. So at this moment, we are more skewed towards the bigger mega tech companies because of the reasons that I mentioned just now. Recently, we just downgraded semiconductor. We were positive on semiconductor for quite some time, okay, if you follow us. But recently, we downgraded to neutral because the valuations have gone up quite a bit. So we continuously monitor this, okay, and when opportunity arises, we'll share the articles. So another segment within tech that we think is cheap right now, in fact very cheap, is Chinese tech companies. If you follow our articles as well, they have dropped. If you look at Hang Seng Tech Index as a benchmark, they dropped like about half already. And a lot of these tech companies are very strong companies like Tencent, Alibaba, all these, they are very strong fundamentally. They generate a lot of cash flow and they hold a lot of assets, which could be undervalued, okay, because all these assets are not listed as well. They could be listed in the future to unlock the potential. But if you know how they work, they are like a venture capital for tech companies as well. Okay, they invest in other tech companies, and then they help the small tech companies grow as well. So their business model are very interesting. Then in terms of valuation, Tencent is like 20-something PE right now, which is like the cheapest, one of the cheapest you can get for Tencent in the past, I think, decade or so. And at this moment, because of the Chinese government clampdown, therefore you got this opportunity. Otherwise, you will never have the chance to buy all these Chinese tech companies at this kind of prices. So I would say, do you think tech overvalue right now? It depends which part of tech. Then healthcare, we still continue to favor it. Okay, 3 stars rating for healthcare. I think the COVID-19 pandemic has definitely changed the world, changed the way healthcare works already, and it also emphasizes the importance of healthcare sector. And a lot of these healthcare companies also expected to do well after pandemic, because during the pandemic, maybe a lot of, let's say, surgeries or what were delayed. Okay, the non-urgent surgeries were delayed. So after the pandemic, I think they'll come back. It's sort of the pent-up demand that we expect over there. What about information ratio? Information ratio is different. That one is best used to compare between different funds. Similarly, is how they fluctuate compared to the benchmark. So it's different purpose, not for this purpose. What is the optimal RAR in a portfolio? Okay, I would say it depends on your target return. Okay, so if your target return is, actually, I think if you can achieve like RAR like 1 is already very good. So because if you look at the individual funds, right, they're like 0.8, 0.8. So if you can achieve something 1 and above is very good already. But it depends on your target return also. If your target return is like 10%, then if your peers are producing like RAR of 0.8, then you're producing 1, then yeah, it's already very good already. So it's used to compare relatively to within other funds in the same category. What do you think of US utility and consumer staple ETF? Wow, this one out of topic already there. But okay. To be honest, I don't really cover US utility, but US consumer, that one is definitely going on quite strongly. If you look at the number in terms of the consumer confidence index, the retail sales number, the and also the jobs number, the job market in US is going on very strongly, recovering very fast already. So definitely it will lead to better outlook for all these consumer staple companies, right? Because when people have job security, they have income security, then they're gonna spend money, right? They're gonna spend money, the retail sales number come out, and then consumer related stocks or companies will do well. So ultimately, I think that's a good, I would say, will do well going forward because of the recovery. Is the expense ratio for hedge funds higher than non-MYR hedge cost of the hedging? No, it's the same. It is the same. So the way hedging works is, okay, so okay, the expense ratio is the same, but the return is the same, but only difference is honestly, I think the best answer for this is it depends. So the way hedging works is, okay, you go into a hedging contract and there's an interest rate differential. So if, let's say, Malaysia hedge to let's say some other currency, maybe that lower interest, then most likely they will need to pay us back the interest, sort of something like that. So there's no cost over there. But if the other way around, then got some cost over there. So I think the best answer to this is it depends on the what currency. How many years US under neutral or lower 2 to 3 star compared to China and Asian with 4 star, but all along US much better performer even though valuation is higher. Okay, so you're right. I think for quite some time we were neutral on US. Then at the end of last year we upgraded to 3 star, and then now go back to neutral again because of the valuations. Ultimately, investors in China and Asian market also doing well. Is the upside is there, okay, but the volatility seems to be higher for Asian and China because we're still sort of like emerging market, considered emerging market. So there's still like more volatility over there. But ultimately, I think if you want to invest, the best is a diversified portfolio in you also need to have US, you also need to have China. You can't miss out on China lah, definitely, and then Asia markets. Then I think if you already have this portfolio for quite some time, will be doing well also lah. Not necessarily underperforming compared to US lor. US is doing well this year, okay, but last year Asia did well, so I think that's why we diversify also lah. Because if you only had, that's why you diversify in terms of if US not doing well, then Asia do well, or vice versa. Then you have both to like sort of average the volatility and the portfolio returns. So to make our life easy, just invest in MAPS. Do you agree? So it depends on investor lah. If you want the easy, if you like to do all this portfolio construction, then monitor markets and do profit taking and timing, all these things, then definitely you would actually appreciate like all these portfolio tools lah. Then if you don't really want this, you want to make life easier, yeah, correct, you just invest in a managed portfolio. It's depends on people lah. And also, yeah, I think if let's say it doesn't meet your, let's say the managed portfolio, it doesn't meet kind of your target, like you don't really agree with what they want to invest in, then you just do it yourself lah. Why some funds in FSM show annual expense ratio lower than, oh, okay, so this is not okay. So when we input the annual expense ratio, we actually take it from the reports, the quarterly report or the annual report. So if it's written there 0.2, is memang take from the reports lah. But this is the fee, I would say it is not the real one lah. The real one should be at least 1.8% lah. Then this one will be I would say the management expense ratio, the additional one lor. So probably the correct one for this one will be 1.8 plus 0.2 lah. Yeah. Because when they take the info, we take it straight from the annual report lah. We don't manipulate the number. So this one I also answered already. It's the same lah. Annualized return is compounded annual growth rate. It's the same calculation. So I think that's all for the questions, right? Still got
I think no more already.
Well, a lot of questions, huh?
Yeah.
Okay. So I hope today's session was fruitful for all of you. Thank you very much and happy investing. You have any closing remarks?
Yes. Thanks, Jason, for your presentation and also address, I think, close to 70 plus questions. And I believe this will be a fruitful session for everyone. And to all participants, let's say if you guys have a more question, I understand because this is quite technical things that you might need some time to digest or something. So if you have any questions, right, you can just drop your email to investhelp.my@fundsupermart.com. So we will address and we will reply you accordingly. So there is several upcoming webinars from different topics. So you may visit our FSM website to find more details and register online. Okay. So again, ladies and gentlemen, we hope this session added value tools to your investment decision and for your investment journey. With that, thank you, Jason, and thank you, everyone. Have a great weekend.